I'll start off with questions that have been directed to Michael. Michael, the first question is, since the ETF is South African, are those who invest in it exposed to the volatility in the rand or the volatility in the US dollar? And this question comes from Rina Hicks. Over to you, Michael.
Thanks for the question. It's quite a good question here. So the underlying asset called gold obviously is actually priced in dollar, right? But the products in South Africa is trading in a local currency, which is the South African rand. I think same thing as what you see in Kenya. So if you are investing in gold, you actually an exposure into basically having an asset that does not only give you commodities but also give you an FX hedge. Like for instance, in South Africa, basically you can use new gold to hedge the devaluation of South African rand versus the US dollar because of what the underlying asset is US dollar. So same as when you're investing in Kenya. So when you buy new gold, it's actually trading in the local currency, but then you actually have a local currency hedge. In other words, if the Kenyan shilling is devaluing against dollar, then by having new gold in your portfolio, you're not only having it exposed to commodities, but you also be able to hedging your FX devaluation against the US dollar. Same thing as an SA.
Okay, thank you very much for that. We have another question from Daniel Areba. Daniel is asking, is it advisable for I beg your pardon? Is it advisable for low risk appetite investors to venture into the gold ETF? Is it a preserve of investors with high risk appetite only? And how effective is gold ETF as an investment strategy for capital preservation? Over to you, Michael.
Very good question again. So basically, the gold as an asset class is normally invested or used by strategic investors like mostly pension fund who tend to be long-term investors whose main objective is to get the long-term return, right? But over and above that, they also want to hedge the downside. In other words, they use the products to get the long-term return, but also to manage the risk, as Mungai was also saying. So an investor, obviously, who's risk averse is actually, I think, an investor who can actually invest in gold because one, you want to actually invest in assets that give you a sustainable long-term return, but at the same time is able to protect your downside in case there are issues like a financial crisis, as we've got COVID right now. So it's not really a product for investors who are speculating, who want to get exorbitant return, but not managing the risk. So if you're investing in gold, you are like a steady investor who want to see a very slow, nice performance over a period of time, but at the same time while you actually protecting your downside, because gold actually acts as an insurance. So by having it in your portfolio, you're actually insuring yourself against the downside. So it is basically a good investment product for investors like that.
All right, so it should be long-term focus, and really what you're doing is hedging against a market fall. A final question for you, and then I move over to Nahashan. This question comes from Tivinda Jutla. Tivinda says that Russia has today announced that they have a vaccine for COVID-19. As a consequence, there has been a pullback in as far as the gold price to date has fallen following this announcement. India will be announcing their vaccine on the 5th of August. I think he meant maybe later on in the month. In his opinion, he thinks that the gold price will drop, but he wants to hear what your opinion is in as far as trading on uncertainty, and if we're getting closer, what does this mean for the investment case for gold? Over to you, Michael.
Okay, I think it's actually quite important for investors to understand that gold is not only used as a diversifier, as a risk management tool, but it's also an investment class that gives you a long-term return. So it gives you those kind of perspective. So yes, I mean, if you're looking at the history for the past, 50 years, gold obviously move up and down. But if you're looking at over the period, it's always been going up. Yes, maybe if they announce that the vaccine is actually found, the price will obviously be impacted. Of course, I'm not sure by how much, but over the long term, the price will also come back and actually give you a positive return.
Okay, so Michael, is this a short-term blip, or do we expect this downturn to continue from where you stand?
The downturn for
just the price correction that we have seen today, is this temporary, or do we just keep looking at the triggers to see what direction the gold price will take?
Yeah, in fact, if you're looking at what we've seen on equities, it's not the first time that you've seen the equities market actually rallying or doing well. I mean, in the past 2 months, we've seen that happening over time. But again, I mean, the rally of the market is, as my colleague was actually saying, that it's actually really influenced by a lot of cash available, and investors obviously cannot invest all their money into gold, but they can invest some of it into equities since they can't go into bonds. What's called bonds are giving them negative yield. So so it basically is, I think, given there's a lot of uncertainty happening around, I think this is actually a blip.
Okay, fantastic. Thank you very much. I'll move over to Nahashan. And this question is from Bajusha. And he says, no, I beg your pardon, it's from Joseph Kahinda, who says, Nahashan, given the break over the 2000 levels and the new highs set over the last 2 weeks, here 2075, how do you then set the target TP/SI levels with no previous technical levels to use as a reference? Joseph continues to ask, do you just trail the stop to wherever this will get, or do you use some form of projections based on your own method, be it psychological or Fibonacci or any other tool? I guess he's trying to get a sense of what is the price outlook and what methodology or what tools can he be able to define a top, a ceiling, and a bottom for this particular trend
All
in
right,
gold.
so when it comes to how you take a position in gold, I just want to be very clear. You have to think of this as a very long-term play. So we advise that it should form about 5 to 10% of your portfolio. And if it's about 5 to 10% of your portfolio, then you don't really want to play very short term. So I get the sense that, I get the sense that he's trying to understand how far back the price of gold can pull back. So is everyone hearing me?
Yes, please go ahead.
Oh, okay. Okay, it was frozen a bit over here. Yeah, so back to the original point around, we feel that uncertainty will continue. We feel that interest rates are going to remain low. We feel that there's going to be a lot of liquidity globally for the foreseeable future. So what kind of targets are we looking at? We are actually targeting $3,000 an ounce. That's our initial target. So yes, we might see a pullback, and we don't really want to get into talking about how we use technicals, like you mentioned, your Fibonacci lines and probably your RSIs. We don't really want to get into the technical bits, because then that's usually for much more short-term trading. What we like to do here at Mansa when we're looking at this gold investment is that it's something that we constantly hold in our portfolio and actually keep increasing or adjusting it to align with the growth of the fund. So we're not very sure about it, and we actually think that we could go as high as $3,000 an ounce.
Okay, so $3,000 an ounce is the ceiling that we are looking out for. Mr. Joffrey, I come to you with a question from Bajusha, and he says, this one is for Mr. Joffrey Odundo. Do you feel that the minimum quantity to buy gold, which is 100, and if you multiply that by the price, which gives you a minimum ticket size of 210,000, do you feel that this entry level is relatively high for the retail investors? If this minimum quantity can be dropped to 1 unit, this is what Bajisha is proposing, do you think liquidity will increase and then you avoid crowding out most of the retail investors? Mr. Odundo, is there a level that this price can come off, or is there a minimum number that can be revised downwards to address liquidity? Over to you, Mr. Odundo.
Well, the minimum that is set of 100, that's really a limit to set up in the rules, and that's actually the minimum quantity of any unit of any stock that can trade on the NSE. And that's a similar scenario we had to use. And ideally, the profile of investors we see at the exchange are ideally not very low value investors. Apparently, the median of our retail investment pool is something in the region of about 500,000. So we feel that it's a fair level to bring them at. Of course, these are considerations we can take in the future, depending on the kind of liquidity we see coming through. But we looked at this also against what we saw in our unit trust and other funds. So there's a very clear process and science around it. So we've taken that into consideration, but the future would really be dependent on how we see the trading volumes happen.
Okay, thank you very much for that. I'll now be taking just brief closing remarks from our panelists. If you can make them as brief as 30 seconds. I truly wish we had more time. That would probably be something to be considered later on. I'll come and take the closing remarks from in the order in terms of I'll start with Michael, then I'll go to Nahashan, and I'll go to Geoffrey. I know we haven't been able to answer the questions, and I am going to endeavor to just work with the Upset team just to make sure that these answers are available to you if you are streaming online or if you were part of this webinar. As we take the closing remarks, there's one pertinent question that we didn't answer. Perhaps you can give us guidance on this. Who is this gold ETF for in terms of how do you think about portfolio allocation? And then we can take your closing remarks from where you stand. I'll start off with Mr. Michael Mugwaba. Over to you.
Yeah, so in my closing remarks, I would actually like to take this opportunity to talk to investors again, as I've done a roadshow before, talking about them investing in gold. And at that time, the price was not as good as we obviously see right now. So I'm saying, I think it's important that in managing their portfolio, they must actually consider to have gold as part of the portfolio. And in terms of how much they can put in, I mean, it depends on the level of risk that the portfolio they're managing is actually having. So the higher the risk, I mean, I think much more gold you can actually allocate. But generally, I mean, studies have shown that at least a well-diversified portfolio must have at least between 2 and 10% of gold in it. So make sure that you're actually covering in situations like this whereby you've got COVID and stuff like that. So I will actually recommend them to say they must look deep into their portfolio and not just on focusing purely on return, but they must also look at how they're going to manage the risk in case something like this happens. So you must consider having gold as part of your portfolio.
Okay, thank you very much for that. You must consider having gold as an existing portfolio. Nahashan, over to you in terms of your closing remarks and any commentary if investors are thinking about portfolio allocation in as far as gold is concerned. Over to you, Nahashan.
Well, my closing remarks would be, first of all, on Mansa X, we've already done. Okay, so we've already diversified and factored in gold within our portfolio. So my closing remarks would be, if you are investing out there and you're trying to look for a fund manager, please look and consider fund managers like Mansa X, who are constantly looking to invest in new products like the new gold ETF, and will continue to do this over time because we believe it adds value, not only in terms of increasing the returns that we give our investors, but also protecting against the downside risks that we've seen in the local stock market. And then in terms of, sorry, and then in terms of the portfolio allocation, we recommend between 5 to 10%, depending on your risk appetite, because again, gold remains a very volatile asset as well.
All right, thank you very much. That is Nahashan Mungai. He is an executive director at Standard Investment Bank, and you know him for the Mansa X product. He's telling you if you are looking for a fund manager, he's certainly up there in terms of consideration. And if you are looking at doing gold at an individual level, then let it be 5 to 10% of your portfolio. I now invite Mr. Geoffrey Odindo, the Chief Executive Officer of the Nairobi Securities Exchange. Kindly give us your closing remarks and maybe any direct communication just to the investors in terms of the safety of this product. Where is the asset held? How do their holdings look like from a sense of the CDSC and the regulatory oversight as you give us your closing remarks? A very warm welcome and over to you, Mr. Odindo.
Okay, thank you. Mine is to say that when it comes to allocation of this asset class, I think it's very important for long-term funds to participate in it. We've got pension funds, insurance funds, and also collective investment schemes. I think it's important for you to have an exposure to gold because it actually provides you with some level of protection and also over the long term, good appreciation of value. So as Nahashan has said, Michael, I think I really recommend this for that class. Also for the retail, I think today Kenya has a very deep pool of collective investment schemes. I think in excess of 60 to 70 billion shillings. So you already understand how collective investment schemes work. ETF have a similar mechanic, and I think there's no real difference other than the fact that this is a listed security. So getting an exposure, you're not getting into something new, something quite similar. So I'd recommend also for you to participate and going into funds like Mansa X and get some exposure on the retail side. I think my message to investors out there is that the NSE has actually deepened and broadened the market. We have given you all asset classes available. This is one attractive one. And let's not lose the benefit of hindsight. We came from 1,250. We are now at 2,000. We don't want to be talking a month from today and it's at 3,000. And Nashon has already given you a prediction. And then you said, I wish I knew. So we have the benefit of hindsight. I think God gave us that benefit. Let's learn from that and let's take opportunity and get exposure to this. You never know when the next black swan or event is going to happen. You could say COVID will come and go. What next? I mean, this is a very big surprise, and another one could present itself. And so let's ensure our portfolios, let's insulate them using products such as this. Thank you.